Hello, this is James Milan, and welcome back to Dollar Sense. As always, I am joined by Joe Camargo, our resident guru, and today we have a special edition of Dollar Sense because we've taken a field trip, and we've come to the Boston Federal Reserve Bank, and we are here with Dr. Jeffrey Tutel, who is a senior vice president here and the director of research, a doctor by virtue of his PhD in economics. So Dr. Tutel, thank you so much for joining us.
Thank you for having me.
And we're here to find out all about the Federal Reserve, or as much as we can today. So if you wouldn't mind just beginning by letting us know, what is the Federal Reserve exactly? Why was it created, et cetera?
So the Federal Reserve is the central bank of the United States. It was actually, we began the Federal Reserve. We needed it for years, actually. But there was banking crisis after banking crisis in the 19th century. And the only way to stop those banking crises before the Federal Reserve existed was J.P. Morgan, or some huge banker, would step in and stop the panic. So in 1907, there was a banking crisis that J.P. Morgan said, it's too big for me. I'm not big enough to do this anymore. And everybody realized we actually did need a central bank in the United States. So they started the Federal Reserve, and it was to prevent bank runs and try to make sure that the dollar was sort of sound and maintained to the gold standard. Mm-hmm. So that was why it was started.
Yeah, and we understand, I think most of our viewers understand that the Federal Reserve is our central bank, our federal central bank. But how is it set up? I think people are familiar with the Board of Governors in Washington, D.C. We occasionally hear about them and their decisions or their meetings on the news. But how is the broader Federal Reserve set up?
So it is actually a lot of central banks have sort of copied our model, but it's not intuitively obvious that this should be the model. It's this is what they decided in 1913 was a good model, and then in 1935 they revisited it, and so this is sort of the vestiges of what they had. Basically, there are the governors in Washington who are nominated by the president, and the Senate advises and consents on that nomination. But then there are 12 reserve banks that represent each district. It's called a district in the United States. And they cut the districts up sometimes a little funny, sometimes not so funny. I mean, we're in Boston, we're the district for New England, and that makes sense. We're the bank for New England. There are other districts that you couldn't say New England or the West Coast, you'd have to say something else. But we have 12 bankers. So there's the FOMC, which determines policy. The FOMC always has the 7 governors voting. And then there are 5 regional presidents at one time who vote. And that rotates, that responsibility rotates among the 12 presidents. One bank president gets to vote all the time, and that's the New York Fed president, mm-hmm. because of their role in Wall Street.
Okay. And just to clarify something you just said, and I know we'll talk about this a little bit more later, but you mentioned the FOMC, and that's the Federal Open Market Committee.
Yes.
And I just want to make sure our viewers are aware of that, and as I said, we will dip back in to find out more about that with subsequent questions. One thing I'd like to ask you about also is that everybody is aware, I think, of what we call the Fed's dual mandate. Right. If you can explain exactly what that is, and I'll leave it at that for now.
So the Federal Reserve was founded actually by Congress, and Congress determined what the goals of the Federal Reserve were going to be. And those goals were going to be basically maximize employment, and they wanted stable prices. So the dual mandate has to do with those goals that were written into the legislation and written into subsequent legislation since the Federal Reserve Act in 1913. Basically, what we're trying to accomplish is to stabilize employment at full employment, and we'd like to do that at a price, an inflation rate that was low, so low that it didn't actually adversely affect decisions in the economy. And that's what Greenspan used to say. He'd say, well, I'll tell you what the optimal inflation rate is. It's the inflation rate that doesn't have any effect on decision makers in the economy. And that's what we're trying to do, is trying to get to that dual mandate.
Mm-hmm. And Joe and I have spoken
few times.
Various times about inflation and the Federal Reserve's role in controlling inflation, et cetera. And we have mentioned, it's come up, that inflation has been kind of a non-factor for quite a few years now. I'm wondering, is that because the Federal Reserve is just doing such a great job? Or are there other factors? Or is that still obviously it's a central concern. Is it a great concern?
So inflation is always something that we have to be vigilant about. That's the word you'll always hear central bankers use. We remain vigilant. Since the 70s, where inflation sort of got out of control, it was a long process to try and tame that inflation. Now, I don't know if you gentlemen were old enough, but in the 70s, inflation got up to something like 10, 12, 18%.
The days of hyperinflation, as they say, right?
And in some places there was hyperinflation,
Sure.
but here 18% inflation was hyperinflation. True hyperinflation is much higher than that. But Volcker came in, and there was a huge recession, and monetary policy took a long time to try and drag inflation back down to something that was more normal for the United States. That stabilized at about 4% in the 80s, got down to about 3 or 2% in the 90s, and since then, since 2000, has been probably below the 2% level. Up and down, there's some variation there, but it's been very low. Yeah.
Mm-hmm. But nonetheless, as you say, vigilance will ever be required.
Right. So we fight in economics all the time about what caused the inflation in the 70s. One hypothesis is that we weren't vigilant enough about inflation in the 70s, and so it was that need for the economy to be able to expect from the central bank that it was going to be vigilant and target something that made sense. And it wasn't a target that they weren't sure about. It was a target that we'd actually tell them what it is, for example. So recently, the Fed has started to release what its inflation target is, an actual number. And for the past few years, they've released something on every January, to tell you what the inflation target is. Mm-hmm. Currently, it's 2% on the PCE.
Right, and if I could just touch on that just a little bit, another concern that a lot of folks have deals with the concept of deflation. Mm-hmm. So can you maybe touch on that and maybe expand on the definition of, or how we're looking at the term vigilance, because the Fed obviously has this dual mandate where it's looking for full employment and price stability. And obviously it wants to keep inflation in line. But some folks have some concern that perhaps deflation is also a consideration that we might want to look at as well.
Deflation is a concern. Actually, being away from 2%, so being below 2%, is a concern. If we're trying to target 2%, we should hit 2%. So this is something that, because of the recession, the depth of the past recession, it's taken us a while to get back to the 2% level of inflation. At the very depths of the recession, that when you're in a recession, that puts pressure on prices and wages to fall, and that's how you get deflation. And so we were actually approaching something that we might consider deflation. I think the CPI got down to something like 0.5% growth in 2010 or something like that. Yeah. So we were getting close to what was called deflation, which is any inflation that's negative. And that was a real concern for the U.S. back in 2010. That was part of the reason why we had such extraordinary measures in the QE, quantitative easings, that occurred after that. So it was just to ensure that we did not have deflation. And we have, over the past few years, there hasn't been risks of deflation in the U.S., but there have been risks in other areas of the globe of deflation. Yeah.
Yes, and that's a really interesting point to me that you made a little bit earlier in that comment, that when the Fed sets its inflation target, it's not up to that number that they're looking for. They're looking for as close to that number as possible, and
Right.
less than that is not necessarily a good thing.
Right.
Not something I had realized before, so
Right.
thank you for that. Excuse me. I know another issue that can sometimes be controversial among economists is the difference between monetary policy and fiscal policy, and I was wondering if you could comment a little bit, clarify that for us.
So fiscal policy is determined by the Congress. They get together, and when they talk about government spending and they talk about tax policy, that's what we basically define as fiscal policy. Monetary policy is, although we're an arm of the Congress, monetary policy is slightly different. And what we're doing is we're affecting, in general, usually we're affecting one price, one relative price, and that's interest rates. Interest rates are a relative price of goods today versus goods tomorrow. So that's the price that we affect. And anything that has to do with affecting the interest rate directly, that's open market operations. That's why it's called the Open Market Committee, by the way. That's defined as monetary policy. So that's the difference basically.
And you just mentioned again the Open Market Committee,
Yes.
the FOMC. If you could just tell us who comprises that committee, and what precisely does it do, if anything, beyond what you've already explained?
So the committee is, as I said, part of it revolves around the 12 presidents. Right now, there usually are 7 governors. There are only 5 governors right now. The chairperson of the committee is Janet Yellen, and there are 4 others. So there are 4 other governors right now.
Is it an unusual thing for there to be only 5? Is there a reason for that, or?
I think the reason has more to do with the ease with which people would get consent in the Senate.
I see.
Yeah. So it happens, but it's not usual. Yeah.
I'm sorry for that interruption. Right. You were talking.
So the other members of the Board of Governors are Lael Brainerd, Jerome Powell, and Tarullo and Yellen.
Mm-hmm.
So those are that's the Board of Governors. Sorry.
Mm-hmm.
And the presidents, I don't think you want me to take 12.
Fair, no.
Name 12 of them.
No, just in general, in terms of you already described that it is the 12 regional presidents who are rotating through that and the leadership of it. Right. So moving more towards what you do here at the Boston Federal Reserve Bank, how do you and your team, your research team, help the Boston Fed president, Eric Rosengren, prepare for his FOMC meetings?
That's a really good question. So before each FOMC, we're trying to figure out what is the best monetary policy to get us to our dual mandate. Now, the problem with monetary policy is it works with long and variable lags. It's not like going over and turning on a light switch where immediately the light goes on. It's more like you go over, you turn on a light switch, it gets slowly a little lighter and a little lighter, but it takes, say, a year and a half before you really kind of know how light the room is. So because of that, we have to use forecasts of the economy. We have to sort of project what the economy is going to be like in a year and a half. And then we start turning the light on early, right? And so what we do basically is we go over the forecasts of the economy. Now the board has a very, very detailed forecast which they send out. It's called the Teal Book now. It used to be called the Green Book. So we pore over that forecast. We have our own take on the forecast, where it could be, where we think it could be improved, where the issues are that he might raise at the FOMC, and try and formulate a policy that makes sense according to what his beliefs are about the economy and his tastes, by the way.
What are the major components that would go in? I mean, I'm sure it's a very complicated whole set, but if you can describe any of the major components that would go into the development of this kind of forecast.
So the forecast has, hundreds of economists who work on this forecast. That, they're all parts of the economy. They sort of look at consumption, they look at investment, they look at housing, they look at exports, they look at imports, and they're looking at details of these. So they're looking at consumer durables. They're looking at, they'll go down as fine as you want to go almost, and they're trying to predict it. Now, all of those things add up to GDP. So there's an adding up constraint. So you can't just go to somebody and say, who's head of the consumer durable forecast, and say, what are consumer durables going to do over the next year? You have to tell them what's going to happen over the next year. What are interest rates going to do over the next year? What's the exchange rate going to do over the next year? What's foreign GDP going to do over the next year? And once you tell them that, they'll try and get an estimate of what's going on with consumer durables. And then once we get all those together, you can put them together and see what's going to go on with GDP. So you can see it's a very, U.S. GDP, you can see, so it's a very complicated process.
Absolutely, sounds complicated and very contingent, each person, each part of that needing information from the other components, the other contributors before they can give you any kind of definitive answer.
So ultimately the model solves itself by making sure that all those things add up, so that the consumer durables people are using the same information about income as the autos people or the investment people.
Yeah, it sounds like an awful lot of trees, and then the model hopefully will actually give you a vision of the forest at some point.
Yes.
Dr. Tutel, I have a quick question.
Please.
Very intuitive to look over here. Can you talk to the relationship between the Teal Book and the Beige Book? There's a lot of talk about the Beige Book and the fact that overall macroeconomic data is actually accelerating. So if you could just kind of dig down a little bit and talk about the sort of things that the Beige Book is intended to do, what sort of things it's reporting on.
So the Teal Book is a forecast of the economy to come. So, and it's also put together by people who comb over the data that we're getting from the BLS and the BEA and try and figure and by the way, the foreign data, and try and figure out what's going on with the economy over the next couple of years. The Beige Book is a snapshot of what was going on over the past few months. And so they're different concepts, but hopefully they're related. And certainly in the near term, hopefully they're related. Hopefully the Beige Book is sort of an indicator or helps predict what's going on with the economy right now. So we have a forecast of the third quarter of 2014, what we think that's going to be in GDP terms. The Beige Book may inform that forecast a little bit, given that we're getting information from people who are important producers in the economy.
So both a trailing as well as a leading indicator in both senses.
I think it's certainly a trailing indicator, and hopefully it's a coincident indicator.
Sure. Yeah.
I'm just not sure. I'm not sure how leading it is. There have been studies that have looked at whether this is a good leading indicator, and the results honestly were sort of mixed. So,
thank you.
Yeah.
And just to shift our focus a little bit, another thing that Joe and I have mentioned and have talked about in some detail in previous dollar cents segments is the relationship. Well, we look at things locally, we look at things nationally, and we look at things globally. And we thinking about the things from the global perspective. We're aware that we have our central bank, which is the Federal Reserve, and that for instance, there's a European central bank. I'm sure there are central banks for various regions and countries in the world, or all of them. We're just would love to hear a little bit more about what the differences are in structure, in pressures that are brought to bear, in variables that you have to deal with, et cetera, between, let's say, the Federal Reserve and the European Central Bank.
So we're lucky that the Federal Reserve is dealing with one country. So there's no issues of sovereignty. So California doesn't get all up in arms about monetary policy because it's different than what monetary policy should be in Texas or New York. We sort of assume that monetary policy in the U.S. should always be the same. Now that's very new for the Europeans. When they became unified in a currency as single currency, they suddenly gave up this idea that they had control over their own monetary policy. And what that meant was that they gave up control over their currency values. And so this is a profound change from what they were doing for a very, very long time, since the gold standard, basically. So there's a huge difference there. Politically, are they there? Are they in the same place we are? No, because we have a unified federal authority too. So if Texas is doing really well and California is doing really poorly, then it's not just monetary policy that's trying to help out the country, because it's a national instrument. You can have fiscal policy, take some money from Texas and give it to Californians. There can be transfers there. And they do it, and we do that. And it's sort of like workmen's, unemployment insurance, things like that are ways to sort of transfer funds from places that are doing well to places that are not doing so well. Europe doesn't have that mechanism.
Yeah, a little bit more difficult to take some money from Germany and give it to Greece,
Exactly.
for instance.
Yes, exactly. And so we saw the whole dynamic playing out, them trying to work their way through that. And so it was, it's much easier for us to just say, we'll do monetary policy, which is a national instrument, and you guys worry about the transfers between yourselves, you guys being Congress. But in Europe, they didn't have that choice. So it was more complicated.
I agree. I think it's fascinating to watch the two different systems work independently, yet at the same time cohesively. You have a lot of the major central banks right now looking to, and in fact over the last 5 years, looking to stimulate overall economic growth, global economic growth. So to watch the Fed and then to watch the European Central Bank enact their own policies with one goal, obviously, to stimulate additional macroeconomic growth, is for me is very interesting to watch.
Some of the surprises about the Fed is how much the Fed does, right? It's not just actually monetary policy, that there are large parts of the regional banks that are devoted to other types of policy. One is payments policy, and the other is supervision and regulation. So supervision and regulation is, we are a major supervisor of the banking system in this country. So we go make sure, we have examiners go out and make sure that the banking system is sound, and we're trying to figure out how to do that in a better way, in a more coherent and rigorous way. And we're huge players in the payment system. So a lot of in the old days, checks used to come through here all the time, and we were the institution that distributed those checks. So those printed, embossed insignias you got on your check when you got it back, that was from a Federal Reserve district. So they all used to come through the Fed and then get redistributed. And so we are, much of the employment in the Federal Reserve system actually is doing other things besides just being a monetary policy institution. So I think that's surprising.
Yeah, and I guess I would just like to follow up by asking a more specific question,
Sure.
which is, I know that during this most recent financial crisis especially, I kept hearing that the Federal Reserve is, printing money, that throwing money at the issue, et cetera. Is that in fact an accurate characterization? Or?
So the Federal Reserve wasn't printing money. We don't print money. What the Federal Reserve was doing was it was increasing reserves. So with the liquidity crises that happened, and I mean crises, it happened several times during this last recession and financial crisis. We had to provide the liquidity for the system so that the system wouldn't come unhinged. And so that's why we were doing those quantitative easings. We were increasing reserves. That was one of the reasons. We were increasing reserves so that systems that had, or financial markets that had frozen up could actually become unfrozen again. Mm-hmm. And we were in Boston, we're actually in charge of one of them, which was the AMLF. And so that helped, unfreeze the money market mutual funds when they froze up.
So by increasing reserves, you were saying that's what you would do. You're basically telling somebody else who will print the money to print more money, or is that not
Well,
accurate either?
whether it turns into money or not is the consumer's choice.
I
It's
see.
the banker's choice. So when you talk about banks having a lot of reserves on hand, those are excess reserves now. And what are they doing with those reserves? Well, for a long, long time we were trying to get them to invest more, go out and loan more with those reserves. But you can lead a horse to water, but you can't make the horse drink. So only the way money is printed is actually when consumers start to demand it, and that's when banks actually are active in loaning those reserves out. So there's more loan growth is increasing now, and maybe money's increasing now, production is increasing now, but that's not really what we're worried about, money creation, right? What we're worried about is employment and inflation, and those are not directly tied to the money creation.
That's great.
I think those are all excellent points. You talk about the liquidity crisis that we had, the multiple crises that we had during the bottom, I guess, if you will, the trough of the economic cycle, 2008 through 2010 generally is when people refer to that time period. There was, when we speak about liquidity crises, you had an enormous reduction in consumer confidence and business confidence and consumer sentiment and all sorts of things. And as a result, corporations stopped their capital expenditure spending or greatly reduced them. And banks also, in turn, stopped lending.
Right.
And generally speaking, unless you had grade A credit, it was very, very difficult to obtain some sort of a loan, some sort of financing. So I think it would be interesting for the viewers to understand that as you mentioned very well, the Fed came in and created some liquidity, and you can argue certainly, as you said, you can lead a horse to water. You've injected all sorts of monies into the economy, and there's still a lot of discourse these days as to whether or not these major institutions are doing enough to lend in order to stimulate economic growth. But just to touch on some of the things that we talked about recently, the Beige Book and anecdotal evidence that the economy is in fact improving, I think it is, and I think, as you said, you want that creation of liquidity to translate into consumer spending, because as we know, it's the consumer that drives overall the bulk of economic growth. And I think anecdotally, and I don't know if you would agree with me, but I am seeing a fair amount of improvement in many sectors within the economy.
So the economy is certainly turning around in the past 3 or 4 quarters, except for the first quarter.
Right.
We've had pretty strong growth.
Sure.
And if you look at employment growth, it's hovering almost at 200,000. Now, you'd expect with the aging of the workforce in the U.S. that, the equilibrium employment growth per month would be something like 80,000 or something like that. If it's growing 200,000, we are closing the gap. Sure. to get back to full employment. I think one interesting question is really what tools we had to use. So we did, with the federal funds rate, lowering the federal funds rate, lead the horse to water, but they weren't drinking because it was a very severe recession. And it wasn't just the financial crisis, it was that the recession was so deep.
Sure.
So nobody wants to invest when when demand is falling 10%.
Right.
So what we did is we tried to change other relative prices. So usually we deal with the federal funds rate, which is just the interest rate in the reserves market. So it's an overnight interest rate. What we were doing with the quantitative easings was not just injecting reserves, it was in fact moving longer-term interest rates down. And it's because those longer-term rates were the rates that actually determine whether a firm invests. So as we were moving those longer-term rates down, consumers and home buyers and firms that were investing said, these rates are so low, I can't put it off anymore. I have to go and do it. So it was a non-traditional tool for us, but in a sense, it was really a traditional tool. It was an interest rate. It just wasn't the interest rate we usually dealt with. Mm-hmm. So that's what we were trying to accomplish with a lot of the quantitative easings.
Thank you so much for taking this time to talk to us about what you do. It's important work, and we appreciate it very much.
Thank you for having me.
And thank you again, and thank Joe, of course, for joining us here at the Federal Reserve Bank in Boston for Arlington Public News. I'm James Milan. Thanks for joining us.